I'd like to introduce and welcome Dave Knox. He's a senior contributor at Forbes and the CEO of Nature's Willow. Dave, I'll let you guys take it from here.
Awesome. Well, thank you, everyone. It's a pleasure to be here. This is really about the two guests that I have on stage with me. So Tamina and Stephen, welcome to the stage, if you will. Looking forward to spending some time and talking about funding over the next 30 minutes.
Thanks for having us.
Thanks.
So let's start off with some quick introductions. If each of you can briefly kind of introduce yourselves and talk a little bit about your fund or your firm in each case.
Take it away, Tamina.
All right. Thanks, Stephen. Thanks, Dave. Hi, everyone. Really excited to be here and looking forward to this discussion. I'm Tamina Hayter, and I head up Harry's Lab, which is a division within Harry's Inc. Many of you may think of us as a men's shaving and grooming company, but we actually have 4 brands in our portfolio today, and we're actively looking to add additional brands into that portfolio. My role is really focused on we're identifying new opportunities for Harry's to expand into and thinking about opportunities to acquire brands as well as to build new brands, leveraging all of the infrastructure we've built at Harry's to sort of scale and grow CPG businesses.
Great. Hey, everybody. This is Stephen Himmel. I'm a partner at Venterra Capital. We are a private equity firm with offices in New York City and Miami. We invest in a number of industries and strategies with a particular focus in venture in consumer and consumer credit. So within the consumer space, we look for companies that have an ESG mission. Those are basically businesses with the mission around better for the environment, better for society, and better for you. Some of the notable companies in our portfolio are Nottingham Cashmere, Hue Products, Quip Toothbrushes. Most recently, we invested in Package Free Shop.
Wonderful. Well, Tamina, I want to start really quickly about talking about Harry's Labs, because I think that will set the stage really nicely for the discussion. Why did Harry's choose to kind of go down the path of looking at investing or acquiring brands, as a kind of a new brand yourself?
No, it's a great question, Dave. It's really interesting. I think we're a founder-led company. And in so many ways, I think the journey to create labs was inspired by the journey that our founders had been on and what it had taken to grow Harry's into the brand and the scaled brand that it is today. And so why did we think about labs? I think it really stemmed from the realization that the capabilities that we had built internally to support the scaling of Harry's. So in particular, all the infrastructure that was required to build to take Harry's from being a small, disruptive DTC brand focused on the shave space and shave and grooming space into really a omni-channel men's grooming brand, were things that a lot of other brands out in the world that were starting on DTC could benefit from. So in particular, kind of the capabilities we had built around scaling DTC. How do you really take, the early learnings you have and the early analytics that you're running and figure out how to do that at scale and continue to grow? How do you take what's working on DTC and translate that into a retail environment? How do you be disruptive at retail the same way that you've been disruptive within DTC? How do you leverage the design and the messaging that you sort of like leaned in on? And then of course, all the infrastructure. How do you go to market successfully? How do you have the right infrastructure in place around distribution, warehousing, finance, legal, IT, all the things that are required to make a brand scale successfully? And then we had this realization like, wow, we could help a lot of other brands do that. And I think the other thing was that we feel really passionate about our mission at Harry's, which is to create things people like more. And it's been so exciting as a brand a company that started with a brand disrupting the shaving space, really focused on delivering a better experience to consumers in that category and thinking about how we could do that in other categories. And guess what we realized was like, there's a lot of opportunities to go do that in other areas. And so why don't we lean in with founders who are finding ways to do that? And of course, we'll continue to start our own brands, but guess what? We're really cognizant of the fact that we don't have all the good ideas, and that acquisitions are a great way for us to tap into other great ideas. I apologize, I think my video is freezing a little bit. This is the hazards of doing these things over Zoom.
Exactly. Well, the purpose of today is really to kind of give some insider tips to the audience, people that are out there as entrepreneurs. In the last decade, we've seen an explosion of new brands, and in particular the last 5 years. As investors, how do you look at the crowd? How do you find those businesses that are jumping out, intriguing you? What's that early funnel look like? Stephen, why don't we start with you?
Yeah, sure. So, I think for us, it's obvious top of funnel. We're looking for companies that do have a mission component. We're really looking for win-wins across the board. So, backing products, backing businesses, again, that have that either better for the environment angle to them, better for you angle to them. I mean, these are, categories where the millennial and Gen Z buyer is really kind of, craving. So, within the health and wellness space, how can we find functional food and beverages that are making your life better, improving your health on a day-to-day basis? From a product standpoint, how are you basically creating a supply chain that's more environmentally friendly, with has a more socially responsible component to it as well. So that's basically the top of the funnel for us. When we dig into the business a little bit more, a lot of it is just based on working with people that we really like. A lot of soft skills around diligencing the founders of these businesses, making sure that they have a strategy in terms of how to scale their business in a capital efficient manner. How do they work with people? How do they think about building that team and building that culture where everyone at the business is going to be all in?
I can chime in. I think a lot of what Steven said really resonates, and there's a lot of, I think, overlap in terms of how we think about top of funnel and what businesses could be attractive for Harry's to partner with. Maybe just to add a little color or a little bit of the Harry specific flavor. I think there's sort of three things I think about a lot when we think about as a business or like hit what would be interesting for us. The first is we're looking for businesses that truly are impacting the experience that customers have. And so that means we're not looking for me toos, we're looking for things that achieve our mission, which is to create things people like more. And that doesn't have a specific definition. So it doesn't mean a better price. It doesn't mean better ingredients. It doesn't necessarily mean it's available in different places, but oftentimes it's some amalgamation of those things. And it's really addressing what's going on in the category and what incumbent players aren't doing. And the reality is that a lot of founders start from that place. They start from a place of looking at a category and realizing there's something broken and there's a big opportunity to do something different. And so we're looking for the folks and the businesses that are really inspired by that, because I think it really resonates with us. It's how we start our businesses and think about our brands. The second thing, just to echo what Steven mentioned, is that we talk about this in terms of internal values and external values. So values alignment with Harry's and the way we do business, both in terms of how our brands show up in the world to consumers. So that's things that are very similar, thinking a lot about how do you think about what ingredients are okay and not okay to put into the product. I don't think every one of our brands has to have the same perspective on that, but we think it's important they have a perspective. And there's a bunch of other things that we put in the bucket similar to those. And then the other part of this is internally, like how do they treat and how they build a culture internally around how to grow and build their brand, how to think about mobility of the folks within the team, growing talent. Those are things that are really important to us at Harry's. It's our number one most important thing that we as an executive team spend time on. And so we're looking for brands that do that as well. And then I would say finally, look, I'm not going to shy around from it. It's really important to us that the business has strong business fundamentals. And so for DTC businesses in particular, we're looking for attractive unit economics that make sense. We're looking for folks that are building their businesses in a way that's mindful of the idea that at some point you want a standalone, sustainable business, and that all starts with a funnel on DTC that really works.
From a very practical standpoint, if a brand's sitting there, a founder saying, I check all of those boxes, everything this fund, this investor is looking for, that's me. How do they get on your radar? Is it the classic warm introduction, the cold email? What's the best way to get on your radar in that early top of funnel?
Honestly, LinkedIn. I mean, I think LinkedIn is an amazing platform when you think about the ability to connect with people directly. We're always open to having conversations just from people that reach out. But I think what's important is to really make sure that you have a strong elevator pitch and can get someone's attention quickly. I mean, the things that we basically manage on a day-to-day basis, it's not just capital, but it's also time. And there's always an opportunity cost in terms of taking that quick, 10 or 15 or 20-minute call. So making sure that you are basically, showing your value add and showing your kind of product market fit, whatever it is, right off the bat. The other thing is really just honestly networking with other entrepreneurs. So another great way to get an introduction to, a fund like ours is take a look at all of the businesses that we've backed they're all on the website, all of our portfolio companies. Reach out to some of those founders, someone on their team that's senior, that has a relationship with us, develop that rapport with the portfolio company that we're already working with, and use that as a way to make a warmer introduction into our firm. It's always, at the end of the day, about people and connecting with the right people.
I agree with Stephen. I think we are very open to taking outreach. I think one of the things that's really amazing about Harry's Labs and the context that we work within is that we have a pretty large employee base of folks who work at Harry's who tend to be very connected into a lot of the other brands that are getting starting up, both on the East Coast, but also on the West Coast, throughout the country. And so what I would say is we always take, cold outreach. I'm always open to folks reaching out on LinkedIn, but another great way to reach us is to see if you might be connected to someone who works within Harry's and start the conversation there to get connected into our team.
If you were to break it down inbound versus outbound, how's it kind of break down between the deals that you look at?
Yeah, go ahead, Stephen.
I was just going to say, making the distinction between quality and quantity. From a quantity standpoint, it's certainly more inbound. From a quality standpoint, it's probably a little bit more outbound because we know exactly what we're looking for and who we want to talk to. So, we see, I don't know, over 1,000, maybe 2,000 deals a year type of thing. So just managing that funnel, whether it's the inbound or outbound, is, it takes a lot of time, and you obviously have to prioritize the quantity.
Makes sense. So, when we look at the landscape of, advice that entrepreneurs are getting, especially around fundraising, a lot comes from, I'd call it the more traditional venture capital that's investing in software and SaaS and, that kind of more traditional tech-based businesses. When you give advice to an entrepreneur that's building a CPG business and a D2C business, what do you tell them about the differences maybe between raising funding for a tech company versus raising funding at an early stage for a CPG business?
Yeah, do you want me to take that, Tamina?
Sure, I can chime in after you.
Okay, great. Yes, I think one of the important things just to note is, we're seeing this blending between consumer and technology. So we have a lot of companies that, 30 years ago would consider themselves, purely a consumer business, and now are fashioning themselves as a technology company. There's nothing wrong with that, but I think what we're seeing is basically businesses that are using the consumers as a crutch to build technology, whether it's a really interesting database or some type of technology to improve the customer experience. So thinking about how those blend and thinking about how you're pitching that to your investors is really important. Your ultimate goal and vision for the business is something that you really want to keep in mind in knowing if you are a pure play consumer company or a pure play tech company. When it comes to the difference between the two, on the consumer side, it's really about telling the story. Not even necessarily about the product, just creating, the story around your business, your brand. Are you making a lifestyle brand? How are you building the community around your product and around your business? On the tech side, obviously, it's far different from the standpoint of there's a good chance you may be less consumer facing, but really, what does kind of the back end look like? What are the kind of, picks and shovels look like behind the scenes?
Yeah, I think what I would agree with everything you mentioned, Stephen. I think what I would add is, I think whoever you're going to partner with as an investment, as a partner, as an investor, and therefore a partner in your business, the number one most important thing that you can do is get aligned with them on where you want to go and at what pace you want to move. Because if you go into the relationship misaligned, I have seen that you will end up being misaligned, more and more misaligned as time goes on. And so, I think to Stephen's point, there's a lot of melding between consumer investors today and tech investors, and what exactly is the line and what's the line between a consumer and a technology business. Those are blurry today. And so my advice to founders is to spend time ensuring that you're really aligned with the person that you're taking money from in terms of where you want to go in the pace. And I think the reason why I talk about those two things is that at the end of the day, consumer businesses do tend to have a different growth profile than tech businesses. They grow at a different rate, and they tend to be addressed in categories that have a different type of dynamic. The underlying category is usually growing low single digits, and it's all about taking market share. You may be creating a new subcategory, but that creates a certain type of dynamic in what you could expect from a growth perspective and how the arc of the business. And so you just really want to make sure that you're aligned and that you're not going to be pushed in ways that are uncomfortable for you. The second thing I would just add that's related to that is that at the end of the day, consumer businesses, from my experience, tend to win because they have great brands. Like, brand is the thing. They obviously have to have great product, but a lot of companies have great product, and they always have to run their business well and have great teams. But having a winning brand is critically important. And sometimes there's a tension between growing too quickly and maintaining your brand. And you want to make sure that the partner that you're partnered with really appreciates the importance of the brand and what types of choices that may make you make along the way.
You know, if an entrepreneur is in the middle of fundraising, they've met a great fund that they really enjoy working with, they're super intrigued with it. What best practices are there to get it over the finish line, to get from that those first few meetings to getting that term sheet and getting the deal signed?
I can take that one, Stephen, then definitely chime in. For me, you know, there's maybe three things I would mention. The first is, I think this is a selling relationship on both sides. You're kind of like in dating mode, right? And trying to figure out, like, are you ready to get into a serious relationship? Are you ready to get married? And so it's a lot of parallels to that. But what I would say, similar to dating and marriage, is you want to move quickly away from like sell mode into candor mode. And you want to start to be really open and honest, because I think ultimately people are making a bet on you. Yes, your business, but also on the people that are running the business. And the faster you can get to brass tacks and speaking to one another, sort of like with candor, is the closer you can get, I think, to getting to alignment on a deal. So that's one tip I would give, is like, yes, of course you need to be in sell mode, but don't be something, don't have your brand be something, don't you as a person show up in a way that's not true to who you are, because it will show up later. And you want to make sure that you have a strong partnership for the ups and the downs, which will inevitably come for every single business. And the other thing I would say is, I think, Stephen, you mentioned this earlier, is taking the time to find out if there are folks that have partnered person or the people that you're partnered with in other businesses, and getting to know them. Because I think, one, it can help you understand what will be most important to this partner and what you want to show up as and how you want to make sure that they are sold on your business. And two, it'll give you a really good sense of what kind of partner they're going to be and if they're going to be a good fit for you.
Yeah, all great points. I mean, one other thing I would just kind of add in there is, don't let the structure of a deal be a hindrance to getting something done if it's with someone that you really think is going to be a great strategic partner for you. I think a lot of times people get caught up on, fundraising, whether I'm going to do a convertible note round or a price round or this or that. Don't make it a yes, no. Try and shape the transaction in a way that works for both parties. Realize that, you can always go back out to market. It's not forever. You will have additional chances down the line. Just focus on finding the right partner and building a good business, and everything else will fall in place.
If we take that analogy of the dating that Tamina kind of shared there, take a step further. You've gone to the altar, you've signed the term sheet, you're starting that. What's the best practices for that first 60, 90 days after the check is cleared and you've got that new partner in your business?
I'll just take that quickly. I think communication. I don't think you can ever really over communicate. Just check in, make sure you have a plan and a schedule in terms of, weekly updates, whatever it is. The things that, we value as a firm is having direct and open lines of like access and communication to all of our portfolio companies. It's never a great situation where, you're hearing from someone every day, you sign the term sheet, you close, and then they kind of disappear, and it's hard chasing them down for, financials or whatever it is. So I think you can never really over communicate. Let investors kind of tell you if you need to kind of take a step back or slow things down.
Yeah, I agree with that. I think hopefully when you get to that point, you've already talked about the ways of working that will exist post-close. And so I think one is just, executing on those. So to Stephen's point, if you've agreed, you want to talk once a week, that's going to be a broad strategic call, which is typically how we would work. You want to, talk once a month on financials, like that would be how we work. Hopefully you're at a point at which that's sort of clear. The thing I would say that I would add to that is that we would want to spend a lot of time in that first 30, 60, 90 days in the context of Harry's Labs, really determining and partnering with our founder partners on what are the areas in which we really want to lean in. What are going to be the things that are really going to drive success over the next year to 2 years? And how do I, as like sort of a conduit between the two businesses, identify what resources you're going to need from within our ecosystem and make sure they're freed up for you? And so we would want to spend a lot of time really focused on, yep, we've got big aspirations. We've drawn the picture of where we want to go. What's brass tacks most important right now? And then how do we help you navigate the organization to make sure those resources are freed up?
Perfect. Well, we've got about 5 minutes left here. So I want to get a few of the questions that folks have tossed out to us. Tamina, one person wanted to learn a little bit more about Harry's Labs and really the structure. Are you investing cash? Is it traditional venture fund? Is it more M&A? Can you walk through kind of that, how you think about the portfolio?
Sure. So we are more focused on M&A. That is like what we are our ultimate goal. And just in like, why are we focused on M&A? Like I said, we like to be open and candid. So the reason is that when we partner with a brand, we want to be able and to bring all the resources to bear that we have internally. And it's a little harder to do that when we just make an investment that has a projected exit down the line. So we are an acquirer. That said, we do take a really bespoke approach to how we structure our deals. And what I can say is that we are very conscious of ensuring that there's a moment of the time of the deal that's a great moment for the founder and the business, and a fueling, a sort of an acknowledgement of what's been done to date and some rewards for that success. But a lot of focus is placed on how do we create economic rewards together for the future. And that's really how we think about structuring a deal. So it's not like a typical acquisition. And then I can add, I think it's probably helpful to just give some color to folks on like what size businesses we look at in that context. So we are like sort of focused on brands that are doing 10 million plus in revenue. Really our sweet spot is 15 plus, but we engage with companies at 10 million plus.
So I want to double click a little bit on that, that stage and the amount of funding or the amount of revenue somebody should have, because there's always this debate of pre-revenue, how much do we fundraise? Do we wait to hit a certain milestone with CPG? What are you seeing the trends evolve in terms of when somebody can go out to market and the size of rounds they should be looking at different revenue thresholds, et cetera?
Do you want me to take that, Stephen, or?
Go first.
Okay, sure. I guess what I will say, taking a step back, is like the consumer sector is hot. And there's a lot of investors that have a lot of interest in consumer brands. And so I think people are able to raise money at lots of different moments in their life cycle today. And so that's a great thing. I think it'll drive a lot of innovation in this category, which is exciting to think about. My advice, for what it's worth, is that you should always be thinking about fundraising as what's the amount of capital that I need to get to like a big milestone, and then give yourself a little cushion on top of that. Like that's the sort of like, and at each stage be thinking about partnering with someone that has like, that invest in that stage, that gets the risk reward of that stage, because every stage in your business is going to be kind of different. What I'll overlay on that is, even in the context of a lot of fundraising and funding being available, we're actually seeing a lot of business that have really been like really scrappy and really raised very minimal funding to get to that 10 to 15 million dollars, where founders are really driving. They're really trying to be really thoughtful and innovative about how they get to that threshold, and sort of waiting to do a big round until then, which obviously has a lot of strong economic rewards to it. So we're actually seeing a lot of that, and that's really exciting.
Yeah, that's a great point that Tamina brought up, which is don't think about how much money I can raise, but think about, kind of a smaller raise and getting into certain milestones. One thing I would add on top of that is, don't focus on maximizing the capital raised, really focus on finding the right partner. A lot of times, they're not going to give you the best deal in terms of valuation. There might be a couple other nuances attached to the opportunity, but honestly, working with the right partner is far more important than maximizing, your interim valuation. At the end of the day, you should be focused on the goal that's 3 or 4 or 5 years out and maximizing that ultimate exit of your business. And that's going to be far better fueled by working with the right people and the right partners. So don't worry about maximizing valuation unless you're basically looking to sell 100% of your company.
On that note of valuation, CPG companies, a lot more so maybe than some other spaces, are going to be valued on multiple valued on multiple revenue when you get to that exit stage. What multiples are you seeing in the early stage that people need to be keeping in mind to set realistic expectations, given that the market is frothy right now and maybe might have unintended consequences for you down the line?
Yeah, I mean, the way I think about it is there's kind of a difference in terms of, your relative valuation versus your absolute valuation in terms of what you're looking for. I think once your business has matured to a point where you've seen a track record of a few years of operation, you understand what the revenue profile and the revenue trajectory of the business is, you can maybe price that off of, some type of multiple. But if you're just launching, just getting off the ground and you're pre-seed, or maybe you only have a year of operations under your belt, it's really more of an absolute valuation. So are you looking for capital at 5 million or 10 million or 15 million? I think what's also important to note is, who's the audience? Who are you speaking with? A lot of earlier stage investors, whether, they're a seed or an incubator fund or just an angel investor, they have their kind of thresholds in terms of, I'm not going to invest at a valuation of higher than 10 or 15 million type of thing. They're not really looking at I'm coming in at 4 or 5 times multiple, just because the business is so small. They're really taking a longer term bet and doing a back of envelope calculation. Can this company get to 100 million? And if so, what would my multiple of capital look like at that time?
Yeah, I agree with everything Steven said. I think particularly on the earlier stage, the dynamics are much more absolute dollar driven, and also driven by like the folks you're partnering with, what size of check they want to write, and what their expectations are on ownership in any given business that they're going to participate in. The one thing I'll add as you get a little bit further down the line is, people talk a lot about multiples, and businesses do end up landing at certain sort of like common multiples across different sectors. But I think most investors are actually thinking about, what is this business going to look like in 5 years? And based on that, what kind of return am I trying to make? So if I'm an investor and I want to make a 5 times return, or a 3 times return, or a 7 times return, that's what they're back solving into. What can I afford to pay today based on what I think the business will be worth 5 years from now? So that is sort of, it dictates the multiple that folks are willing to pay. So I would always think about them both in terms of the multiple and the comps, but also like, what's being forecast in 5 years? What does that mean in terms of how much they think the dollars they're putting in today will be worth, and therefore how much might they would be willing to pay?
Perfect. Well, thank you both. It was a wonderful discussion. We will be turning it over to Michelle to take us from here.
Hey, thank you so much for leading that. And Steven, Tamina, you guys are awesome. I personally took a ton from that. I hope everyone listening took a ton from that. I saw a ton of great questions. So thank you, thank you, thank you.